right, well, there's a live look at what's happening with the North American landscape as we kick off the Friday trading session. Feels a bit calmer. February itself has been anything but calm. A lot of uncertainty in the air, not just for the economy through the tariff threat, but even just looking at what's been happening recently with a lot of former high flyers in the market losing momentum. Ryan Bushell with me here from Newhaven Asset Management to talk about all things market related. Good to see you.
Thanks for
I guess my caveat here, before anybody freaks out, is go back in history. February generally stinks for the stock market. But that being said, what have you made of the last few weeks?
I think it's been really interesting, and the two things I've been watching really has been the 10-year bond yield in the U.S., which has come off quite a bit. And this is sort of a classic market response to uncertainty, flight to safety, which has not really been happening in the same way over the past few years, given what's happened with interest rates.
So hopefully, as you're talking, our team can show the 10-year Treasury yield. So I guess if we go back to, call it January, it's like 4.8%-ish, and now it's trending towards 4.2%. So as people buy bonds, the yields generally come down.
Yes.
So what's the takeaway from this?
Yeah. So it's usually classically what would happen is sell equities, buy bonds, right? You're moving to safety, moving to safer waters, so to speak. But with all of the inflation concerns over the past few years, bonds and equities actually have been positively correlated, meaning when people are buying bonds, they're typically also buying equities, and when people are selling equities, they've also been selling bonds. That's correlation flips around depending on, really it's largely inflation expectations, which are all over the place right now with all of these tariff threats. And I think that's the most interesting thing, is that you're seeing economic data slow down, you're seeing uncertainty, which I think is going to manifest into, again, businesses delaying decisions, consumers delaying purchase decisions. We've seen some pull forward ahead of the tariff threats, but beyond that, it's kind of like, where are we in terms of goods demand, consumer demand, and as well, industrial manufacturing spending decisions. Are you going to build a new plant when you can't assure that your supply chain will be able to deliver you products, at the prices you need to make money? So I think there's a lot of concern out there that's swirling around, and every day is a new tweet, a new directive that can throw, again, prolong that uncertainty for businesses and consumers.
Yeah, I was trying to find what is the number one reason for where we're at right now, and I felt like I needed more than one hand. Yeah. It was it's like, yes, there's tariffs or Washington moves, but then that feeds into confidence, which is both tangible and intangible.
Totally.
But then there's other things like valuations in equities, which everybody was already sort of whispering about, but they get a little bit more vocal about it when, I guess like Nvidia, which had insane numbers. Mm-hmm. Just for the record, they had insane numbers, but the market doesn't really celebrate it. It's like people are looking for where the momentum is going.
Yeah, and so we wrote this in our Q4 commentary that you've got a really sort of dynamic and I don't know what the right word is. It's been a long time of the U.S. government racking up a huge debt pile, and now we're sort of pushing against some of the limits on that. And so you're in a position where, they're trying to bring back manufacturing. They are trying to change things geopolitically. They're trying to a lot of conflicting objectives, right? We're going to deport a bunch of people, but we need cheap labor. We want interest rates down, but we're going to put tariffs on things, which causes inflation. And it's hard to tell what's actually going to get done, but it's sort of a fire hose of directives that may or may not come to pass, and that breeds uncertainty for the market. At the same time, you've got what I think is a classic stock market bubble in AI, a new nascent technology, overinvestment. The DeepSeek news from a month ago, I think, proves that the $300 billion that the big 7 AI companies are supposed to spend just in 2025 is likely too much. And so you've seen with these Nvidia earnings, yes, the numbers were good. Yes, the demand is still there because people are, in my view, over-ordering and getting cut back, and that will eventually start to taper off. And if that stock can't rally the market and is now making new lows post the DeepSeek news, it's a bad sign decline for the S&P 500.
We're going to come back and talk a little bit about some investment ideas. Before we get there, though, you've been through a lot of market cycles. I have as well. And one thing, especially going back to the financial crisis, that I noticed is we're always sort of seeing how much pain we are willing to administer on ourselves through our investment portfolios. And I do think it's an important question, because even going back to the COVID pandemic, it was like, how much stock market decline do we have a tolerance for? The reason I'm asking that question is, it sounds like you're saying the communication out of Washington is creating some turmoil in the markets.
Totally.
But last time I checked, Donald Trump likes the stock market, and he likes to see the stock market go up. Is there not a theory here that if he's watching the markets respond poorly to what's coming out of D.C., that he might maybe fine-tune his planning to reverse that at some point this year?
I think that's
because we are in a bull market. I just want to remind people.
Totally, yeah, and I think that's very possible, and I have said that to people that we've been talking about this, and it's been an interesting time to have these discussions, right? And so it's interesting to think about, okay, again, all these conflicting objectives, which some are inflationary, some are deflationary, some are good for the economy, some are bad for, like, deregulation, but spending cuts and to the government side of things is bad for the economy, because that's been a major source of growth in the economy over the past couple of years. So again, there's a lot of things that are going opposite directions. It's hard for me to tell if this is a well-orchestrated symphony of changes that they're making, or if it's very haphazard. Sometimes it seems very erratic. And so what I would wonder is, that brings any uncertainty brings the chance that something different might happen. And so I keep wondering, what is the rabbit they can pull out of the hat on the stimulus side that will get the economy and the market feeling more positively again? But until it happens, I think we're in a stage right now where it's very clear that the market is reacting negatively to these policies.
All right, well, we're going to take a break. Obviously, it has